So what I thought would make more sense would be able to create an operating business that would be able to stake at 100% capacity because we didn't have the 24-hour redemptions. And we would be able to also avail ourselves to the restaking ecosystems as well as the DeFi ecosystems. So that's what we've built in the Ether machine.
Hey everyone, welcome to the Level Up podcast, presented by the Medici Network, the exclusive community for financial institutions to engage with blockchain-native funds and founders. I'm your host, David Breiter.
And I'm your host, Sean Farrell. Before we kick things off, make sure to hit the subscribe button and follow us on Twitter for the latest episodes.
This podcast is for informational purposes only, and nothing herein should be considered financial, legal, tax, or investment advice. The views expressed by our hosts and guests are their own and do not reflect those of the Medici Network, Fundstrat Global Advisors LLC, Finality CP Management LLC, or their respective affiliates. All listeners should consult their own professional advisors as to the legal, tax, financial, or other matters before making any investment decision.
Now, let's get into it.
Hey everyone, welcome back to Level Up. David and I have another DAT conversation on deck today that we're pretty excited to get into. We're going to be speaking with Andrew Keys, co-founder and chairman of Ether Machine, one of the larger Ethereum-based DATs out on the market. Maybe we start by running through some quick stats. David, you want to take us through it?
Yeah, and Sean, I like that. Another DAT day here on the Level Up podcast. We have Ether Machine, ticker ETHM, and it's, around 1050 trading at price. It's one of the SPAC approach. One of the DATs took a SPAC approach as opposed to the kind of direct listing or reverse takeover approaches. About a 2.7 billion market cap currently. And, as Sean mentioned, comps are, the other large Ethereum DATs, Bitmine, SBET, Ethereum, and others. And, also like many of these in this sector, following the MicroStrategy playbook. And Ether Machine has, based on some recent reporting, about 2.3 billion of ETH. And we estimate that to be around a 1.2 times multiple. And we'll talk about a lot of that as we go into the show a bit more, I'm sure.
Yeah, and like I said, they are one of the largest ETH DATs. They've, as David mentioned, they've amassed an ETH holdings of approximately $2.3 billion. And I do want to note that the data that we're working with right now is as of October 6th. I know that, the market just went through some pretty substantial volatility. And so these numbers might be a bit different by the time this goes out. But yeah, they're in third place behind Bitmine and SharpLink at this moment in terms of treasury size.
That's right. And I mean, I think the interesting story of late really has just been the accumulation story for the different assets and what that's done for the price. I mean, obviously, Bitcoin had such a strong performance in the last few years as MicroStrategy was driving a lot of growth, but that slowed significantly. And, really the Ethereum DATs overall as a category have, really taken over that show. And I think it shows in both the ETH performance here. And you can see as a percentage share of the total supply, what is held by DATs for all DATs for each asset. And obviously ETH has been very strong. So Ether Machine is riding that trend.
Yeah, and look, they have come to market in a much different way than some of these other DATs. The other two larger DATs, SBET and Bitmine, they went to market through the pipe offering, reverse takeover type go-to-market strategy. Ether Machine is going to market via SPAC. The transaction has yet to close, but despite that, they've been able to still acquire a pair of significant slugs of ETH. And so, they found ways to acquire ETH despite not being able to access that ATM like these other DATs.
Yeah, that's right. You can always do the private market route. And that's what they've done so far, waiting for the transaction to close. And curious to get some timetables from Andrew on when he thinks that'll happen. But, here's the trading volume for the DATs shares, right? So the trading volume of DAT shares get for the underlying asset. So think of, the trading volume of MicroStrategy and other ETH DATs versus Bitmine, Ether Machine, and other ETH DATs. And, I think the thing to note is that, ETH trading volume has really become 50% or more as of late of DAT trading volume. And I guess what does Sailor say? Liquidity is vitality or something like that. Is that saying right, Sean?
Sounds about right.
That's about
And if
right.
not, that does sound like something that Sailor would say.
And if not, maybe we'll coin it here on Level Up first. But I mean, the key really, is this trading volume because liquidity does give you the ability to sell shares for many of the DATs. And I mean, Andrew is taking a different approach with Ether Machine. Here, you obviously have the volume for the ETH DATs, and Bitmine is the most liquid here. But again, as we mentioned, I think Andrew is taking a different approach, and will be exciting to hear about that.
It'll be interesting to hear whether they, choose to go the M&A route. I know Andrew has mentioned some things here and there about perhaps being a bit acquisitive with their currency in their shares once that transaction actually goes live. But here you have the entirety of the ETH DAT comp set, or at least all of those ETH DATs that I guess really matter. And you can see that very few of them are trading above NAV as of October 6th, Bitmine being the notable one. And then the other one is Ether Machine at 1.2x NAV.
Yeah, I think that's right, Sean, and it's going to be exciting to see if they can hold that when they launch and grow it, hopefully. And this is the performance of just the three largest Ether treasury companies: Bitmine, SBET, and Ether Machine. And Ether Machine's really been kind of the middle of the pack just as of the date of this chart, and will be interesting to see how this trades after the SPAC goes live. And then finally, really not a lot of technicals you can do on a chart like this. Such a new SPAC listing. I just think the only thing you can say is it's trading in this range, kind of around the deal price, the SPAC price, which is typically $10. So it's kind of trading in a 10 to maybe 11 range over the last month and a half, and we'll see if Andrew thinks there's a lot of compelling reasons, and I believe he probably will for this to break out. Hopefully, when the SPAC goes live. So, anything else you're looking forward to getting into on the show, Sean?
No, I think that about wraps it up. Just looking at this technical trend chart and some of the volume charts, I think the moral of the story is that the clock hasn't really started for these guys just yet. Because that transaction has yet to close. So, like you, I'm looking forward to getting some kind of time frame on the prospective closing of that transaction, and yeah, just hear more about how he plans to execute and perhaps differentiate himself from these other DATs.
All right. Well, with that, let's get into the show.
Andrew, welcome in. Really excited to chat today. This is our second installment of our ETH DAT series, if we want to call it that. We're excited to hear from you about, the strategy that you guys are pursuing. From what David and I understand, you're taking a bit of a unique approach to the DAT strategy. But before we get into that, would love to just get a brief background on yourself. I know you have been in and around the crypto ecosystem for a very long time, specifically within the Ethereum ecosystem. So maybe we start there.
Sure. Well, thanks a lot for having me, Sean and David. I appreciate your time. I have been around the Ethereum ecosystem since inception. Prior to Ethereum, I built a revenue cycle management company that processed insurance claims, which is kind of a boring business. But basically, in that business, I learned everything that was wrong with payment systems and databases at the same time Bitcoin happened. And I said, well, Bitcoin was this kind of funky experiment in monetary policy, but there was only one asset, a Bitcoin, and one function to send. And that really didn't interest me because from my prior experience, I knew that the world was a bit more sophisticated. And when I read the Ethereum white paper and saw essentially the codifying of legal agreements where we could digitize any assets and embed those assets with arbitrarily complex logic into digital legal agreements and say, if X were to happen, then send a payment, else failure. Simply put, that if then else statement being a smart contract, I thought that had tremendous potential. And I met a handful of early Ethereum protagonists at the first ever Ethereum meetup in Manhattan. Aaron Wright, who created the Lao, was there. Joseph Lubin, who is the one of the co-founders of Ethereum. And Joe was considering to build what he called at the time crypto Google or crypto Alphabet. And I volunteered to work at Consensys without salary initially to embark on that vision. And basically, the first time Ether crossed $1, we created the implementation of Ethereum on top of Azure. So we basically uploaded the Java client in a permissioned cloud context and enabled institutions to tokenize any assets and trade those tokens in real-time gross settlement. And we had a 100-word article on the Wall Street Journal declaring the concept of blockchain as a service in October of 2015. So literally 10 years ago. And that was the first time Ether crossed $1.
Was that the Enterprise Ethereum Alliance or something else?
No, so I helped build the Enterprise Ethereum Alliance as well. That was 2 years later. So these were very early days. And the Enterprise Ethereum Alliance was focused on creating standards. And if you kind of go through the history of technology, Java became J2EE, Java 2 Enterprise Edition, and it became the most used software language due to the ability for standards, meaning that if you had clean web APIs and clean database APIs, and you were an engineer in Mumbai or Paris or New York or San Francisco, you were using the exact same standard. And that's what kind of permeated Java 2 Enterprise Edition. And we believed that we needed to create standards around Ethereum. So, some of the famous standards are the ERC, the Ethereum Request for Comment 20 token standard. There were wallet standards. There are identity standards. We're starting to see standards occurring in agentic AI for Ethereum. And so basically, I helped build Consensys from the ground up, sat on the board of directors. Consensys created 3 of the 12 implementations of Ethereum, as well as one of the most used developer wallets named MetaMask. And then I created a commodity pool operator and commodity trading advisor, so a CPO and a CTA that was registered with the CFTC under the acronym of DARMA, which is Digital Asset Risk Management Advisors. And since the inception of Ethereum's proof of stake, we have been staking bare metal servers at institutional scale. And so basically, tens of thousands of validators, billions of dollars of Ether without a single slashing event. And this kind of brings us to where we are today. And basically, where we are today is that about 6 months ago, one of the large Ethereum ETFs came to me and asked me to be a market maker for their withdrawals. And basically, it's important to note that the ETFs in America have 24-hour redemption requirements. And if you are following Ethereum right now, there's a 42-day unstaking queue. And basically, the ETFs in the United States are not going to be able to stake at full capacity. And they basically approached me as one of the largest institutional stakers and asked me if I would market make that delta. And at this point was when I realized that the ETFs were going to be inadequate for public market investors to have staking yield. So simply put, if you look at the Ethereum ETPs in places like Canada or Europe, they're staking at 50% capacity, meaning that if you had $1 billion of Ether, only $500 million of it's being staked, 50% capacity. And that was only earning what I would call the vanilla staking yield, not participating in restaking or DeFi. So what I thought would make more sense would be able to create an operating business that would be able to stake at 100% capacity because we didn't have the 24-hour redemptions. And we would be able to also avail ourselves to the restaking ecosystems as well as the DeFi ecosystems. So that's what we've built in the Ether machine.
Yeah, that's a great overview, Andrew. And it's, I mean, obviously it's, it's clear. I mean, you and Joe have really, of the ETH DATs are the people who have kind of been there the longest and really seen the full evolution of Ethereum. Let's talk about like a little more on like why Ethereum, right? What's the thesis there and like the investment case underlying the asset? Like maybe, a little bit, is that changed over the years since you got involved? You've been in it for a while.
You may consider me biased. You may consider me an ETH maxi, but what I would say is I believe Ethereum is the only blockchain capable of being the substrate to the next generation of the internet. And I'll just cite kind of two data points that are facts. And everyone's going to have opinions, but to stick with the facts, the Financial Accounting Standards Body has a definition of assets, and there's a definition of what are called high quality liquid assets, things like stable coins, real world assets, stocks, bonds, derivatives. And right now, we're in the opening act of blockchain still. Even though we're 10 years later since the inception of Ethereum, there's $250 billion of high quality liquid assets on all blockchains. 90+% of those high quality liquid assets settle to Ethereum. Liquidity begets liquidity. And what I would say is that if one understands that 90% of those assets are settling onto Ethereum, that is, I would say, escape velocity, similar to Google with search, where 90% of searches happen on Google. And Ask Jeeves gets 1%, and Bing gets 1%, and Yahoo gets 1%. So the second largest blockchain has, I think, something like 7% of the high quality liquid assets, and then it drops down precipitously. So that's like the first consideration. The second consideration is the ability to have 100% uptime. Ethereum has 12 implementations that form consensus every 6 seconds. And since inception of the Ethereum network has had 100% uptime. If you're talking about a global, credibly neutral settlement layer for Earth, Ethereum is the only one that has this type of client diversity. So basically, if there's a bug in one of the clients, the other 11 can continue to form consensus. And then lastly, I would talk about decentralization, which for the global settlement layer of Earth, which is really what I'm interested. I'm not necessarily interested in, trading meme coins. This is the most decentralized network on Earth. And so what we've seen with, and with the largest security bounty in the world in terms of Ethereum's proof of stake network, securing, basically there's $150 billion bug bounty right now that Ethereum's proof of stake consensus mechanism has. So I think those are a few reasons why I think that Ethereum is poised to be the next generation of the internet.
On our last episode of the podcast in Singapore, we had Vitalik on, and it was after a panel with the him and some other people at the foundation. The one thing that struck me most is, I feel like Ethereum, like the foundation, has gotten much more commercial recently. They're much more engaged with like going out to investors and like connecting on like use cases and Wall Street and adoption over the tech. I mean, you've been around it a while. Have you seen kind of the inner workings of some of the governance, like, evolve over the years in that direction as well?
Absolutely. I mean, I think what we've seen is 10 years ago, literally at Microsoft, when we created the concept of blockchain as a service, we went out to every Fortune 500 and they didn't have a blockchain team. They had kind of a young, new to the team computer scientist that was allowed to play with this technology. 1/10 of their working day. And now what we've seen is the evolution where uh, Fortune 500s have to have a blockchain team. JP Morgan has a team of 50 people that solely work on this. And furthermore, we lived through a political headwind during, I would just call the Gensler era, where tons of work was being done that is now turned into a political tailwind. The Genius Act that recently passed in July is earth-shattering for this technology. It basically gave the green light for every institution to digitize the dollar or their currency, the British pound, the Japanese yen, et cetera. And basically, we're starting to see not only the banks having digital dollars, but places like Walmart having their own version of a digital dollar. And what this is going to do is it's going to increase the velocity of money and create a price discovery mechanism for the value of intermediation. And so you're starting to see the ability to pay with USDC, and then the good is 3% cheaper because we don't have to pay the credit card processing companies.
So maybe if we circle back to talking about Ether Machine, how should folks think about trade-offs in owning ETH, the asset, versus DATs broadly? And perhaps from your perspective, if you want to speak to Ether Machine's strategy and how they should think about the risk exposures to Ether Machine versus spot ETH.
What I would say is, first we differentiate Bitcoin versus Ether. There's already a category defining winner in Bitcoin with MSTR, and Bitcoin, probably more importantly, does not generate yield. And that's one of the reasons, aside from kind of all of the data points that I gave, why I think Ethereum to be the next generation of the internet, why we chose to deploy Ether. And then when we kind of get into, I would just call it, broadly speaking, let's call it the top three vehicles. Two of the three, SBET and BMNR, are shell companies where they did a reverse takeover of a previously dying microcap. And I think that Joe is going to do a great job. Tom's obviously doing a great job already. I personally couldn't get comfortable with deploying my own capital into a shell company. There's a notion of what I'd call contingent and pre-existing liabilities, where we purposely did not want the previous operating business of these shell companies, the previous governance structures, the previous cap tables. And basically, we wanted a de novo, a brand new entity without any of those previous risks, because we didn't know what skeletons are in the closet. You're seeing that some of these companies now are essentially holding aside part of the capital that's invested for potential class action lawsuits from the previous operating business. And so what we've done is we've gone the de novo route, that is a clean operating business that's brand new, without pre-existing management, pre-existing operating expenses, and pre-existing governance. And so what I think broadly, when we talk about, spot exposure versus the ETFs versus a digital asset treasury, so one can acquire Ether and they could potentially stake it in their own retail exchange account. And the retail exchanges are typically charging in excess of 25% of the staking yield. And then the owner of that Ether is required to deal with the public-private key pairs, which I don't think the majority of retail is ready for, especially if they're allocating large amounts of their investment capital. It feels to me like weekly we see these horrible stories of somebody losing their life savings because of a hack on one of these exchanges. So that's, I would say, the first is spot exposure, and you could stake it through an exchange and they're going to charge an egregious fee. Secondarily, one could go to the ETF. Right now, the American ETFs are starting to enable staking, And we believe, due to this withdrawal queue nuance specific to Ethereum, there's only going to be 50% of staking capacity. And that's what we're seeing in Europe and Canada. So if you think of this like a perpetual bond, it's half the yield. So it's probably, worth half as a perpetual bond. So it's like availing yourself to a stock that pays a dividend, but only getting 50% of the dividend. And then lastly, there are the digital asset treasuries. And I think that there are two ways to think about the digital asset treasuries, kind of on-chain exposure and off-chain exposure. And what I mean by that is that our digital asset treasury, for example, is able to generate Ether denominated yield via staking at full capacity versus the ETFs. We're able to stake everything. And that's our first bucket of activity. Secondarily, there is another technology called restaking. Restaking is taking Ethereum's proof of stake consensus mechanism and using that to secure other middlewares. So Eigenlayer is one of the kind of the lead examples in the restaking space. And Eigenlayer had $100 million raise at $1 billion valuation by Andreessen Horowitz. And about 2 years prior to that, I personally invested $2 million at the $25 million valuation. So basically, my firm has been very close with the Eigenlayer team in the user experience and the yield generation from restaking. And I believe that this is going to be another place where we can add additional alpha to the portfolio. In addition to participating fully in staking, we're also able to add additional yield restaking. And then lastly, we can participate in the DeFi economy. Whereas versus the ETFs, they're only going to be able to stake 50% and not participate in restaking or DeFi. So that's the on-chain part of the equation. The off-chain part of the equation, which is very important to the ability for the digital asset treasuries to add value, is they can access the public equity and credit markets. Simply put, we can sell our stock for additional Ether, or we can trade and actually participate in what I would call accretive M&A. I think that there's a certain critical mass of volume or assets that these digital asset treasuries have to have. We're going to come to market with likely $3 billion of committed capital. If you look at kind of the price of Ether right now, there are a bunch of digital asset treasuries that are trading below NAV that are, $100 million, $500 million, sub $500 million. And I think that all of those are going to probably get rolled up. So basically, we can do accretive M&A using our public company stock, and we can issue credit. So in the form of either convertible bonds, or we can issue preferred shares. And I think another important thing to note is that another benefit of the going this de novo route without pre-existing liabilities like the shell companies is that our vehicle is the first vehicle since MSTR to achieve a Big Four audit. And so we just achieved a Big Four audit with KPMG. And that's important because the bulge brackets don't want to touch any entity that doesn't have a Big Four audit. So our investment banker is Citi versus kind of, if you go through these shells, there's a bunch of no-name investment banks that I've never heard of, no-name auditors, no-name law firms. We use Citi, KPMG, and Skadden. And basically, if you understand how this trade works, what got MSTR from single-digit billions to centibillions was the ability to issue convertible bonds and preferred shares. And basically what they did was they were selling volatility to hedge funds that wanted to acquire volatility, and they were using the underlying asset. They were using those proceeds, the dollars, to acquire the underlying asset for shareholders that wanted exposure to Bitcoin. And that's what really drove MSTR from single digit billions to cents a billion dollars. And there's basically being on the right side of that reflexivity and having a MNAV that's positive. And we, with our KPMG audit and our bulge bracket investment bank, believe that upon completion of our business combination, we're going to be the best situated vehicle with the best structure to actually participate in the convertible bond and preferred shares that are very similar to what MSTR employed to go from single digit billions to centabillions.
That's really great, Andrew. And there's a lot of stuff I want to dive back into and unpack, especially on the operating business side and DeFi restaking stuff. But sticking on the capital market stuff, let's remind the viewers and just walk people through kind of the history of your structure. You raised a SPAC. How much was that? What was put in, and then any other comments on the timeline you can provide for that closing of it.
So on July 21st of 2025, we announced our business combination agreement where our de novo entity, the Ether Reserve LLC, which was a brand new LLC, was intending to merge with the Dynamics SPAC. And we announced the 1.7 billion, 1.6, 1.7 billion. I don't have the exact number, but let's call it over $1.5 billion of committed capital, of which I personally committed 150,000 Ether. If you look in the digital asset treasury space, that is the largest personal contribution by a multiple. I think that's important because I am only going to act in methods that are accretive for myself and my shareholders, and I'm going to lead by example. I think there are examples that I've already seen of kind of dilutive instruments, and I'd be happy to kind of explain, an example of one later. But basically, I am Ether denominated in my brain, and our North Star is increasing our Ether concentration and our Ether generation per share. And so we had a $1.6 billion opening round. And then we had a subsequent follow-on round where another large Ether investor wanted to deploy into the vehicle. And so we raised another 150,000 Ether worth about $750 million.
What's the valuation on some of those rounds on the pricing of the first two?
So the first round was at $10. The second round was at $10.25.
Got it. So like a 1 and then 1 point single digit MNAV. Is that right?
Yeah. And so the vehicle has currently just shy of 500,000 Ether and just shy of $400 million of committed capital. So 500,000 Ether, you've got, let's call it back of the napkin, 2.4 billion plus another 400 million. So we're at about $2.8 billion of committed capital. And so we are going through what's called a business combination agreement. And so we've filed our we have submitted our S4 registration. And upon that feedback, we should be moving forward to the merger.
So I think you talked about some of the benefits of engaging in a SPAC versus a reverse takeover. You have a empty shell. Could you maybe speak to some of the trade-offs? I think you might have been alluding to some of them before, but what things can you not do that some of these folks that went the RTO path might be able to do? And conversely, what can you do that they can't?
Yeah, I think the best thing that they've been able to do was go out hot off the bat with ATM equity issuance from inception, where we have to basically have our merger occur. And I think that's kind of the key differentiator. But I think that what we're going to see is that it's going to be a longer road to hoe for these shells to actually go through a Big Four audit because they have to deal with the pre-existing operating businesses. And without the Big Four audit, the bulge bracket investment banks will not issue convertible bonds and preferred shares on those vehicles. And I think that that is going to be a key differentiation point over, let's call it the 5-year, 10-year horizon of these vehicles. What we can do differently is that we can participate in what I think our strategy is going to be is going to be participating in accretive M&A, where we're going to be doing roll-ups of DATs that have sub MNAVs, and basically where we'd be able to buy the assets, convert them to Ether, or if they already are Ether, and then we'd be able to basically use our equity similar to how they I would call it the shells have been able to use their equity, but instead of issuing ATM, and then we're going to be able to do the convertible bonds and the preferred shares much easier.
Yeah, we actually just saw our first instance of DAT M&A a couple of weeks ago, and similar in Strive. I thought that was fascinating. Curious, you mentioned the prospect of you guys using your equity to acquire another DAT trading below ETH DAT trading below NAV. Would you ever consider acquiring a Bitcoin DAT or some other altcoin DAT?
So this is definitely an Ether vehicle. We could potentially acquire another DAT's assets, but it would be converted to Ether.
Oh, interesting. So if a Bitcoin DAT was just trading 0.6 NAV, you would buy that, liquidate it, convert. Oh, that's interesting, Andrew.
And I mean, if you're trying to achieve alpha, right, that's how you're going to do it, right?
Just be agnostic with the underlying, right? That makes sense. Yeah, I mean, for me, is it just fair to just like your strategy versus others, right? Like, BitMine and SPAC so far have been very ATM focused, capital markets heavy. I don't even think BitMine's staking yet. They will soon or whatever. But you're really more on the on-chain yield generation, the converts and the cap structure, and then the accretive M&A is like your kind of like strategy focus over compared to those two, right?
I would say, like, if you actually go through our team, we've acquired. I've called them the Avengers of Ethereum. Tim Lowe, for example, built the staking engine within Consensys, rebuilt that within Dharma, and then has built that. All of that kind of comes with him into the Ether machine. We have we have a hired head of DeFi, a gentleman by the name of Darius Pritchell. He's a chartered financial analyst, previously worked at JP Morgan, previously worked at Consensys, previously worked for Steve Cohen, and we don't have an outsourced asset manager. I think that if you look at a lot of these other vehicles, they have an asset management fee that scales with assets. And I don't think that that's necessarily good for shareholders. And basically all of that's happening in-house. And then Dave Merrin led M&A for Consensys prior to this. So basically did over 10 acquisitions using private company stock in the crypto space. And now he's going to have public company stock, which is much more liquid. So basically a very strong M&A lead there. And then in terms of kind of managing a public company, the first three people I just mentioned, Tim, Darius, and Dave, they all come from kind of a heavy crypto background. And then the last gentleman is a guy by the name of Jonathan Cristodoro. Jonathan Cristodoro is leading our public company excellence. And basically, he's a classic underachiever. Harvard, Cornell, and Wharton degrees, then went into the Marine Corps, then was a Morgan Stanley investment banker that worked for Steve Cohen and Carl Icahn, has sat on 10 public boards, including Xerox, PayPal, Lyft, eBay, and Dell, and basically is leading public company excellence within the firm.
Some guys just can't get their life together.
Andrew, I think you guys have a great team for that. I want to shift back to some of the operating business stuff because you mentioned something very near and dear to our heart at Finality. which is like, restaking. We were early into Eigenlayer as well and pretty big supporters of the ecosystem. Maybe like let's talk more again about like some of the on-chain stuff. So how much do you think you'll put into some of these? Obviously, you'll probably stake everything. How much do you think you'll restake? How much do you think you'll put into certain DeFi strategies? How much risk is too risky?
So you guys are fellow, I would just call it blockchain nerds. So you probably came across Vitalik Buterin's recent blog post about what I would call low risk DeFi. That's where this vehicle will sit within the DeFi ecosystem. Basically, we are not going to be going out looking for 100% APYs of the latest and greatest smart contract, because with that, there is tremendous risk. Basically, let's just call it formal verification of smart contracts, I would say, is kind of the biggest risk there. And so what we will do is we will stake an overwhelming majority and stake and restake an overwhelming majority. Let's call it north of 90%. And then we will also work within the ecosystem and basically help build the Ethereum and Ether denominated yield generation ecosystem. And so there are different ways to participate in that. But basically, I would say back of the napkin will likely be somewhere like 90-10.
Got it. 90-10 staking.
Staking and restaking 10% DeFi. I would say back of the napkin. And then I mean, I think that the critical mass of Ether generation and concentration increase, which is our North Star, we believe will come from accretive M&A and from what we would just call financial instruments that we can employ with our public markets structure, like a convertible bond or preferred share.
What do you think? Like, so I don't know, maybe I'm a little off today. Maybe it's 3% base staking rate or something, right, for ETH today, just roughly. And the ETFs only get half of that, so let's call it 1.5. What do you think you'll get kind of as an all-in yield on that?
So we're just starting to see like the earliest signs of small product market fit within Eigenlayer. And just to give you an idea, one ABS restaked, something like EigenDA, can add an additional 45 basis points. So if you have, let's call it 300 basis points of yield of vanilla staking, and then you add 45 basis points, that's adding an extra 12%. And that's just one ABS. And you can basically have multiple ABSs. And I think that you can get with the DeFi, I think we can safely justify higher single digit yields. And so a good blended yield for us, I think would be 5, 6, 7% would be a goal. And basically we think that we could do that without taking unnecessary risk. So basically, if we can get 5, 6, 7% risk adjusted returns, and then further compound that by prudently risk managing convertible bonds and or preferred shares, and then also doing accretive M&A to discounted MNAV vehicles that don't have the scale that we have, and we think the bare minimum scale to survive in this is $2 billion. And so I think that the juice isn't necessarily worth the squeeze under that.
On the converts, what did you think of the BT convert that was just issued and the Zilla converts? And how is that compared to what you're thinking about?
I think because they are shell companies, they were not afforded very good terms and they have relatively low float. I think that we're going to be able to drive down the cost of capital. And unfortunately, in both of those instances, they're on the wrong side of reflexivity and are trading at a sub multiple to NAV. So I think that there are kind of issues there.
So circling back to the on-chain, just to close the loop on the on-chain stuff. So you mentioned, staking and restaking, we get that. What are some of the activities and protocols you expect to be engaging with? I know they're within that low risk DeFi category, but can you cite some activities and protocols you plan to deploy into?
We'd rather save those fireworks for when we're absolutely on chain and live with them. So you're going to have to stay tuned in that regard.
Can you, you should do like Trump, where they invest in Intel, maybe they buy some calls on it before, do that with Aave or whatever.
I mean, I think Aave is a good example of a low risk DeFi protocol that's got $75 billion in AUM. So it's essentially had a $75 billion bug bounty. It's been around for 5 years. So that's something that, is an example of something that we would feel comfortable deploying capital on.
So maybe I think it's a hot topic of conversation, really pertinent on today's price action since we're squarely in the red. But, a lot of folks are talking about systemic risks. I think they're overblown as it pertains to DATs, but it's going to be very interesting to see how markets or how these DAT managers react to a market downturn. Not that we're calling for one, but eventually, everything is a cycle and we will have a downturn. What risks do you view that creating for the market or Ethermine, and how do you plan to operate in that environment?
So what I'd say is this is kind of the part of the conversation where I'd say where I broadly call it play silly games, win silly prizes. And I think there are lots of risks that are involved. I've already kind of highlighted one consideration, which is pre-existing liabilities and contingent liabilities. I think that, a lot of companies have rushed to get a vehicle out the door, and over the next year are going to learn what the skeletons are in the closets of these vehicles. You had a previously dying microcap essentially where it's zero. Now there's $100 million or $1 billion in a vehicle. And that vehicle going forward may be operating a treasury and may have all the best of intentions, but that vehicle has a 4-year statute of limitations that could be subject to class action lawsuits. I think that's a huge honeypot. Secondarily, I don't think that retail necessarily understands all of the financial engineering that can occur in these vehicles. I'll give a broad example. There was a vehicle that announced that they sold their stock at a 14% premium to the spot price on the public markets. And the initial response from him was like, oh my gosh, this company is doing so well. They can sell at a 14% premium to the spot price to an institutional investor for, a couple $100 million. Kind of lower in the byline. It also said, by the way, they gave away 2 warrants for every share that they sold at this 14% premium. So if you actually do the math, they actually sold it at a discount. And if you actually continue that math, the higher that the asset goes up, the more dilution the vehicle gets. And so with my vehicle, selfishly or not, I'm one of the largest shareholders, and my brain only thinks in accretive actions of ether concentration per share. And so I think that if people are aware of the ether or the asset in the underlying vehicle and understand, are they getting diluted if the price of the stock goes up, or is it actually accretive? So I think those are some of the risks. And then I think that these things need real prudent risk management. The digital asset ecosystem is subject to material drawdowns. And you can see some of these converts that are timed, 2 years out. What happens if there's a blue wave 2 years from now and market goes completely risk off right when the converts have to occur? And so we think of this kind of holistically, where we're actually splaying risk. We've thought about, architecting converts over multiple year durations and then splaying preferred shares that are essentially perpetual, but then we have to basically satisfy a coupon of payments. So basically kind of splaying the 2 risks so it's properly risk managed. So I would just say that, there are a lot of kind of subscale low lifts that I think are going to get washed up in a downturn. And then lastly, we've seen this kind of nonsense where we've seen a lock token, that may not even have come out to market yet, be kind of exit liquidity for venture funds, where in any rational action, if I were to sell you an asset that was locked for a year or 2 years or 4 years or 5 years, and you were to acquire it, in 99% of all of these instances, you would probably have a discount to that net asset value of the asset for the time duration risk of that liquidity. And what we're seeing is, rather than, a 50% discount for holding a locked asset, these things are being kind of sold at a marked to market NAV, which I don't think is right. So I mean, I think those are kind of some of the silly games that we're seeing. And what I'm going to differentiate within our vehicle, as somebody who's actually put their money where their mouth is solely working on accretive solutions.
Andrew, how much convert debt would you put on and preferreds? I mean, I know you might tier it, but like, what is it? Is it 0.1? Is it 0.2? Thinking about it.
Yeah, I think back of the napkin, we probably wouldn't take on more than 20% leverage. And we'd like to splay that. And I think the converts would be splayed over a time period. And then I think what we've seen is that the preferreds are really a function of size. And so I think we have to kind of do the converts first and then evolve into the preferreds.
Got it. Now, when we did the panel at Ethereum New York, I thought you gave the most transparent answer to one question I asked, which was, in a downturn, if you're below NAV, would you sell your ETH? What level does it make sense to do that, right? To buy back shares? I mean, obviously it's value accretive.
Yep.
If it's 0.995, maybe not. Is it 0.7? Like, how do you think about that? Does it depend on the market direction?
I think probably I would answer it like a slightly different way. Is like, so we have this committed capital where we had a large tranche of Ether, and then we had a large tranche of dollars. And I think that there's a good thought process to have dollars on hand and not necessarily deploy everything into Ether to potentially defend instances like that. And then I think that the other piece is that this vehicle is generating yield. So what we could always do is we could maintain the principal and then use some of the yield proceeds, if we find ourselves in a position like that, to essentially buy back shares, which would be accretive. It's basically like buying M&A of a different vehicle at a sub MNAV.
One last question on the consolidations, right? Like, what level does it make sense for you to buy others? Is it like 0.5, whether it's Bitcoin or ETH? If you're above, you're at a premium.
It depends on the terms. It depends on, how much does it cost to do an M&A transaction? How much does it cost in the legal fees? Like, what's the size of the vehicle? Doing it for, the 200th asset on CoinMarketCap probably doesn't make sense at all. I think that, those are going to have a lot of problems. But I mean, I think that, if there's a, $100 million, $200 million vehicle of a liquid asset that's trading at, I think you could almost get even as close to 0.9. It could be accretive if you become laser focused and ninja-like in this regard.
Yeah, I think that's right. So maybe that's one catalyst. To wrap it up, maybe let's talk about some others. Are there any other real catalysts for Ether Machine? Obviously, the closing of the transaction that people should keep on the radar, either for you, for ETH, or just as a whole.
I think that we're gonna have a closing of the transaction. We believe that we're going to be able to generate market leading yield without having, external asset management fees. We've got like kind of leaders in accretive M&A. Dave literally ran M&A for Consensys, and we have a very good instinct to the market. And this vehicle is the cleanest operating vehicle there is, I'd argue, in the Ethereum space. So with that, we're probably best poised for institutional financial instrumentation.
All right. Well, with that, Andrew, thank you very much for coming on the Level Up podcast.
Thank you, guys. Appreciate it.
That's a wrap for this episode of Level Up, where liquid token protocols meet the sharpest minds in institutional investing.
If you found value in today's conversation, don't forget to subscribe and share it with your network.
For more deep dives into blockchain's most compelling projects, reach out to us or follow the Medici Network for more insights. Until next time, keep leveling up.